Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news again. And of course, the man that brings us the news, Nick Bendel. Thank you, Nick, for joining me yet again.
I can't help myself. It is a compulsion. And is it just me, or do you have a different backdrop today?
Yes, I do. It's not one of those fake AI backgrounds or anything. I am at a different location. I haven't been kicked out of home, but yes, I am on a working holiday, I guess, because I technically this is work. But yes, getting a well-earned break after a number of no, a little while of a lot of hard work. So yes, but still back at it on the business days, getting some work done.
Well, I know you and your colleagues in Leifield work very, very hard, so I'm glad you can enjoy a bit of downtime, even though I know you are also working.
Thank you. It's Nick, what have you been up to in the last week?
Well, my business, Hunter and Scribe, what we specialize in writing content for finance and property professionals. We've been very, very busy over the past week. Just to give you an insight, Owen, into the kinds of jobs we do, I recently spoke to a mortgage broker who wants to create content about reverse mortgages, another broker who wants to distribute a monthly newsletter, another broker who wants a monthly blog, a property lawyer who wants a quarterly newsletter, and a property valuer who wants regular LinkedIn posts. These are the kind of jobs we do and the kind of people we work with.
Fantastic. It's and they're all people in the property industry, but still a vast array of types of professions that you do service.
Yeah, all those good people, and we also work with accountants, financial advisors, non-bank lenders, credit repair agencies, and of course, there's a good overlap with all those professionals, and they're my people. I like them.
Fantastic. Well, we're still going through the hiring process and looking at interviewing people for our on-the-ground inspection manager, which will be great. It'll be a new role in our business, and excited about expanding our business that way. So, as well as talking to all of our referral partners, being mostly buyers agents as well as sales agents and some mortgage brokers. So, yeah.
Wonderful. Should we get stuck into the news?
Yeah, Nick, what's in the news this week?
We've got three interesting stories. Our first story is rental market continuing to favour property investors. Rental growth may have slowed significantly over the past year, but vacancy rates have barely moved. At a national level, the vacancy rate rose slightly from 1% in March 2024 to 1.1% in March 2025, according to SQM research. At a capital city level, vacancies rose in four cities between March 2024 and 2025. So in Melbourne from 1.1 to 1.5%, Sydney from 1.1 to 1.3%, Perth from 0.5 to 0.6%, and Adelaide from 0.5 to 0.6%. And vacancies fell in four cities. Hobart from 1.3 to 0.5%, Darwin from 1.4 to 0.8%, Brisbane from 1 to 0.9%, and Canberra from 1.7 to 1.5%. Owen, vacancy rates have been so low for 4 years now. Why have they stayed so low for so long?
It's the old supply issue again, Nick. It's we've had a lot of demand. Yes, there's been more supply coming into the market, but just not enough. And investors as well have been very cautious about getting into the market and being cautious about where they're buying and what type of properties they're buying. Yes, they're focusing on those areas with the high demand. That being said, there are areas of lower demand, And yes, but the short story is we need more supply if we want to see those vacancy rates creep up a little bit more.
Speaking of an increase, Melbourne recorded the largest increase over the past year from 1.1 to 1.5%. Is that large enough to be significant? And if so, what has caused that increase?
Not large enough to be significant in any particular across the whole market of Melbourne. But what you would find is those numbers have been skewed by some particularly small markets in Melbourne where they've had a huge amount of supply come in, where there's a lot of new builds, and you would see that the vacancy rates in those areas would be double or triple the average in the city.
Now, I've got a question for you because your business, Leifield, you work with lots of investors in 5 different states, and you've been doing it for a long time. You've got a lot of experience. When you're a property investor, Owen, obviously lower vacancy rates are better than higher. But I'm wondering, is there anything a property investor should be wary of when vacancy rates stay so low for so long?
If it's, I mean, the issues that are caused by it. I mean, generally, yes, they're all good problems for a property investor. But I guess the issues are on a bigger macroeconomic level, where you've got an economy that is struggling to provide more supply into the market, and due to a number of factors, including the cost of increase of supplies, the cost of increase of labour to be able to get that supply into the market. So specifically for investors, there's no real direct negative, but the negative which we've been dealing with for quite a number of years now, and the causes of that have been quite evident to, well, they are to people who understand markets and how they work, that yes, it's a cost of living crisis, which gets talked about a lot, but directly for the property market, it's that cost of building supplies, cost of the labour cost for trades to be able to build the properties. It's hindering being able to put more supply into the market.
Well, that leads us on nicely to our next story, why investors exit the market. New research published by the Australian Housing and Urban Research Institute has found that a surprisingly high 22% of property investors sell their property within the first year. Yeah. On average, investors sell after just 3.9 years. The paper said landlords are more likely to sell if they're separating from their partner, struggling financially, or dealing with high mortgage costs. And property investing involves entry costs and holding costs and exit costs, which is why I've heard as a general rule that an investor needs to retain their asset for at least 10 years in order to enjoy a meaningful return on investment. Does that 10-year term sound about right to you?
Absolutely, and it's a minimum of 5 years to at least start getting any kind of return. And that would depend on the property. And so it's highly important that if investors are buying for long-term investment potential, that they've got that mindset and of buying for a minimum of 5 to 10 years, and they're setting themselves up financially to be able to cope with the ups and downs of being a property investment owner.
I know over the years you've dealt with an enormous number of investors in markets throughout the country, so you would have noticed some patterns of behaviour. In your experience, Owen, what separates the successful investors from the unsuccessful ones?
Well, it's quite a few things. The successful ones have cash flow contingencies. And so that's a big one, especially in that first 5 years that I just mentioned a few minutes ago, where you need to be able to make sure that you've got in old-fashioned retail terms, you've got a float, where you've got a float in the till, where you need to be able to deal with being able to where your expenses are more 1 month than the following couple of months, and then vice versa as well down the track. And there could be some vacancy, so you need to have those funds on hand to be able to deal with it. And so if investors are living month to month on receiving their rent and then paying the mortgage expenses, and they can't even afford that, what happens when an unexpected expense comes up? So that's a big thing that they should be talking to their mortgage broker about, when they set up the loan, to be able to make sure that they've got the ability to handle those ups and downs. And so yeah, see it in time and time again. So that's probably the number one. People don't understand the cash flow contingencies that they need to have in place. So they have this mindset that a property is going to be just a set and forget, and they don't really need to do anything with it. And oh yeah, the rent's going to pay for the expenses, and they just let it sit there and do nothing. No, the answer is no. It's not a it's not a set and forget. Properties have expenses, and you need to expect to have expenses and plan for them.
Following on from that, so we've been talking about property investors buying and selling quite quickly. Given all your experience these days, when you bring someone on as a client, are you able to sense which people are likely to be short-term investors and which people are likely to be long-term investors? And if so, what gives it away?
Yes, to a point. And some people are planning on being short-term investors, and for specific reasons. So it's about asking what their goals are with this property. And it's by asking that up front, they more than likely tell you. It's like, oh, well, yeah, we've got a plan for this or that. And so that'll usually give you a good idea of whether it'll be a short-term or long-term plan. They might be looking at building the property, keeping it for a year or two, and to try and get some capital gain out of it, and then selling it to be able to help pay down their home mortgage or something like that. Or it might be that yes, they've done that, but then they've realised that it hasn't grown as much. There were more expenses with it, so they need to keep it for a few years to be able to recoup their costs at least, so that they're not making a loss on this property. And then you've got the people who want to upgrade their own home. They've been living in this house for 10 plus years, and they can't bear to sell their family home that they've had for so long, and they think it would make a lovely investment property, which is usually the absolutely worst investment property. And and then they realize after a year or two that it's not such a great investment property, and they should have sold it in the first place. And then they end up selling it. So and then going back to your previous question, the people who expect to get the exact amount of rent every month without fail, guaranteed, and without any hiccups of expenses, and any hiccups with tenants not paying rent, and they don't have those contingencies in place for cash flow issues. So they're the main reasons why people would end up selling their investment property earlier than they should do.
Well, let's move on to the final story. Housing unaffordability hits record highs. Since 2003, the median property price has consistently been 6 times greater than the median household income. And this hit a record high of 8 times at the end of 2024, according to CoreLogic. The city-by-city breakdown was, in Sydney, prices were 9.8 times incomes, Adelaide 9, Brisbane 8.2, Perth 7.4, Hobart 7.2, Melbourne 7, Canberra 6.1, and Darwin 3.9. CoreLogic Research Director Tim Lawless said, housing affordability challenges have been with us for a long time, and most economists agree that policies announced in the lead up to the election are more focused on applying a band-aid to the symptoms of housing affordability rather than addressing the underlying issues that have created such an unaffordable housing sector, a long-running undersupply of appropriate housing relative to demand. So, Owen, is Tim Lawless right to say the major parties are trying to address housing affordability problems with band-aid solutions rather than by making a serious effort to increase supply?
Yes, absolutely. They're all band-aid solutions that in most cases are just going to feed demand. And they make some lame attempts to try and increase the supply side. But it really needs some wholesale changes. There's a lot of government taxes on in all 3 levels of government that affect the price of properties, especially brand new ones. So rather than incentivizing the demand, they could actually take away some of the upfront cost issues, and which would help alleviate some of those supply costs to make it easier to build more properties. So and then those prices, if it's easier to build, it'll create more supply, more competition, and prices could at least stabilize in the short term for a little while.
We're having this chat 5 days before the election.
Phew.
ABC voter surveys have found that housing is the 5th most important issue at the election after cost of living, the economy, government operations, and climate change, but ahead of healthcare, immigration, defence, and energy. Do you think the major parties' housing policies are going to cause people to change their votes?
In some cases, it will. I think it will come down to individual circumstances. I think cost of living does form part of housing policy. So it's so I think it's probably a higher concern for most people than that survey suggests at number 5. And but I think a lot of people are fed up of the same but different policies from both major parties. We've got to fix the underlying issues that are long-term issues.
Now, interesting you should mention same but different. So I want to quickly talk about the Greens policies. We've discussed them before, so I don't want to ask you about the merits of the policies. I've got a slightly different question.
Okay.
The Greens housing plan calls for a range of policies, including limiting rent increases to 2% per year, regulating the banks to deliver cheaper mortgages, and establishing a public developer to build affordable homes for both buyers and renters. So putting aside the merits of those policies, do you think they might help the Greens win votes at the expense of Labor and Liberal?
Yes, it's more likely at the expense of Labor, because people who will vote for them based on those policies will more than likely do so just out of pure ignorance of understanding. And I say that in an empathetic way, that there's just a lack of understanding of how markets work, how an economy works, and for people to think that these policies will actually do anything worthwhile long term to be able to help the economy and the housing market, then yeah, it's just plain ignorance. And it's sad that we're at a state where people like this are toting policies that are just so ignorant as to what the long-term effects. They're not thinking of the second and third level consequences of if these policies actually came into place. And we'll turn into a banana republic, another Venezuela. And do we really want that to happen? And people just don't understand. And it's that lack of education, that lack of understanding, that we're really at risk of the Greens having any kind of influence in our parliament. It's dangerous.
Okay, well, this is our final podcast before the election, so we're going to give our final predictions. I think Labor's going to win, and I think they'll have a majority government. What's your prediction?
Yes, that's looking more and more likely to be the case, and frankly, at this stage, I'd be happy for anything other than the Greens having any kind of influence. So, yes, and that's pretty sad.
Well, if it is a minority government, either Dutton or Albanese will have to negotiate with the Greens and or the Teals, and at that point, he might have to give them something in terms of housing in order to secure confidence in their votes.
Oh well, there's yeah. Let's get to next week and actually talk about what's happened, and we'll deal with the consequences from there.
Okay, well, great chat as always, Owen. A lot to think about, and I look forward to chatting again next week.
All right, thanks, Nick, and thanks for joining me, and I'll see you back at the normal location this time next week.